Our featured guest is Wayne Wilbanks, the Chief Investment Officer at Wilbanks, Smith & Thomas. And Wayne, I want to start with you. 2009 ending maybe a lot better than a lot of people thought it would at the beginning of the year, but it seems that 2010 could have a lot of headwinds as well. Why don't you break them down for us?
We definitely think so. The stimulus spending will run out by the time we get to the middle of the year. This is a jobless recovery, something we've talked a lot about. So you got a lot of headwind where this is not a normal economic recovery. So investors need to prepare themselves for a lot of these bumps in the road as we move forward.
What about the positives for 2010? I mean, we do see unemployment looking, or the labor picture looking a little bit better. Unemployment obviously still at 10%, but earnings are expected to grow also at a sincere pace, maybe 20%. A lot of people are saying. I mean, what do we grasp onto here as the positives?
Your three big positives are the massive improvement in the banking system, all these banks paying back their TARP, the $1 trillion worth of reserves that's waiting to be lent out. That's huge good news. The second one that doesn't get talked about a lot is the issue with the emerging markets. They are literally pulling the U.S., Europe, and Japan out of the recession that we're in right now. Business overseas is booming, and that's going to be very beneficial to all of our economies. And then third, what you just said was the earnings comparisons are very, very easy. So companies are blowing their numbers out on the upside, and that'll continue really as you get into the first quarter, second quarter, and after that, that's where we begin to get really worried.
Let me ask you about sectors, and Wayne especially, I want to ask you here, Wilbanks, Smith & Thomas, about sectors for 2010, because you think it's best for the individual investor to focus on sectors rather than looking at individual stocks.
Right, and I think one of the particular sectors is the blue chip, the big U.S. blue chip multinational companies right now, the Pepsis, the Colgates, the Exxon Mobils. These companies have really not participated much this year relative to names like Ford, which you mentioned earlier, which have been, the low quality has been leading the rally here. So that's one sector in particular that we're very excited about.
Wayne, what do you think, though? I mean, do you go for value here in 2010? Do you go with maybe some big quality names here as we enter the new year?
I think you can do a little bit of both. You can buy the big quality names, but there's some of those names in tech that I agree with George on. Microsoft, Applied Materials. There's some of these names that have had a move, but there's a tech cycle coming on capital spending. We see it at our company. We're going to be buying new equipment, new software this year for the first time in a couple of years. So there's going to be some definite spending in that sector. So I think a combination of both might be the best for individual investors.
Is that enough, by the way, Wayne, if we see more business spending here to make this recovery self-sustaining, even if the consumer sort of stays out as far as the spending picture?
I'm not sure it is. I really don't believe that there'll be enough to take up the slack for this consumer. This consumer is in a new world for the next 5 or 6 years. It's we've all been talking about it. They're going to save more money, and they're 70% of the economy. So it'll be nice to see some of these big blue chips start to release some of their money. I mean, Microsoft, the top 500 companies have $1 trillion in cash right now. So corporations are in good shape, and we think companies like ours are going to start spending money, but not enough to make up for the consumer.
And Wayne, we've been talking about, I've been teasing portfolio stress tests for the last couple of hours. Walk us through how an investor can best do that.
Well, they should sit down either with a financial advisor or whoever gives them advice on portfolios. And there's a lot of computer programs now that can take your asset mix, let's say you're 50% equities, 50% bonds, and they can ask the computer will tell you what will happen to that portfolio if the S&P 500 drops, let's say, 25%. And that'll tell you my portfolio then will drop, let's say, 12, 13%. So it's a wonderful time with this huge second half rally for investors to stop for a minute, ask that question of their advisor, look at the portfolio and ask how will the portfolio perform. Not that we expect the market to drop 25%, but not many people predicted it would drop 25% the last time. And what we think you'll find as an investor, people won't be comfortable seeing their portfolio drop 15, 18, 19% again. Because we've gone through a decade where they've seen their portfolios go nowhere. They've seen 2 50% drops in the S&P 500. So it's a really time to decide, maybe I need a little less equities, maybe I need a little bit more fixed income, and maybe short-term fixed income.
And maybe they're already there, once bitten, twice shy. Wayne, thank you so much for joining us. Wayne Wilbanks,
thank you.
There, and George.